Zach, how you doing, man?
Good, man. Long time no see.
It has been a while. Not really. We do the State of the Freight every single month. Sometimes we do it more often. We did one about a week ago, 2 weeks ago, something like that?
Week and a half-ish.
So, but really we talk about State of the Freight using data and really provide an update. People can tune in. It's free. It comes out every month. It is a free webinar. So this is a sampling of it, but it is certainly our most engaged product that we offer at FreightWaves in terms of audience engagement. We do have mics, as Kaylee offered up, suggested on both sides of the aisle. So if you have questions about the market, Zach and I will attempt to take a stab at it. So glad to be here, man.
Yeah, me too. And thanks everybody for coming out today. So I think let's just dive right in to the meat of it. So there's probably one of the biggest questions that I get. I get several questions out in the world. And one of the things that I hear the most is, why is the economic read so different than the freight market?
It's a great question. I think it's something that we've all been asking. I mean, when you look at the state of the freight market, and you look at what it has been same since March of last year, and really you could even go back to January, sort of the peak of the sort of COVID cycle, and this massive continuing downward trend that has, with the exception of a couple of increases, periodic increases, we had the January recovery. We even had the summer, like last summer, we saw the drop that happened in Q2. And then in terms of volume, and then we saw a little bit of recovery in the summer. And then just a really sort of brutal Q4 last year. For the most part, we've seen a market that has been somewhat stressed really since March of last year. And in volume-wise, doesn't tell the story. So we get the volume chart up here. That white line is the current volume in the freight market for 2023. The green line is 2022. You can see that big dip that happened last year. Where we're at this year it's sort of interesting because if you sort of went through, May was sort of the bottom, or April of this year was sort of the bottom. We saw this rally through the summer, and then we've seen this really significant deterioration in October. And one thing I'd point out is this just isn't our data. This high frequency data is measuring volume, which are requests for trucks from the shippers to the carriers, looking at the tenders. One of the other sort of data sets, because we don't just use our own data to draw conclusions, we take not only other data sets, but also anecdotes and channel checks. But we're hearing it from really all the public carriers and the private ones that really there's been a significant deterioration in October. And one thing I'd point out is if you go back and look at the earnings calls that took place in mid-July till August, a lot of those carriers were pretty bullish. Even J.B. Hunt was actually talking about there were some green shoots that they were seeing in August. And if you look at if you listen to the most recent conference call, they've largely taken that off the table.
Yeah, I think it is interesting, especially if you look at some of these earnings calls. The devil's in the details here, where you see these revenue deteriorations, significant revenue deterioration.
I mean, Maersk is certainly the most profound. The ocean container lines have had the most profound revenue deterioration. But certainly in trucking, we have seen significant revenue deterioration, which is a combination of, it's twofold, right? It's rate per mile, and it's also volume. So you have to have both to have a strong market, because they've lost volume in transactions, and they've seen rate deterioration. One of the sort of answer your questions about the economy, if you look at the economic data that comes out from the Fed, or you look at the economic data that comes out from all these various sort of GDP analysis, it looks like a very robust economy. You're talking, 5% GDP growth?
4.9,
They're projecting in Q3, or had projected for Q3. That is one of the strongest economies, and certainly Biden would say the strongest recovery we've ever had from a low. It doesn't feel that way in freight. And the data suggests that the market isn't as dire as what it feels like to a lot of the carriers in the market. But it certainly does not suggest that this is bullish by any stretch.
Yeah, I think that's the key for me, is that yes, we may have seen some, the OTVI that you see here does show that we have been growing almost all year long.
It's a firming of the year, except for Q4. Except for October. October has been a big disappointment relative to where it was, but you're correct that it is certainly up from the start of the year.
Yeah, and it looked like that trend was very atypical. I mean, if you even go back into the COVID environment and the yellow and blue era there, July was not a strong month sequentially off of June.
It isn't.
We saw that this
It
year.
it isn't usually, July is usually a pretty soft month.
Yeah.
And if you, sort of the rule in asset-based trucking is you lose money in January, you lose money in July. Now, some of that's to the July 4th holiday, having trucks sit against the fence. But a lot of it's just related to, manufacturing largely shuts down and retools. The auto plants take 2 weeks off. So really, July is really a month that, the 2 months of the year that every trucking company would like to just be done with and never have repeat is January, maybe February could classify this as well, and July.
Yeah.
This year, seeing strengthening in July, and if you go back and look at where we were in August, we've done this conversation every month, we were bullish. I had turned bullish at least, and I thought, well, the second half is gonna be strong, there's gonna be a peak, a season that's gonna surprise people. Largely that's off the table. We got that analysis wrong, frankly.
Well, when you're looking, I think we've become so accustomed to looking at trucking from a pure demand side perspective because let's be real, like that's the thing that's the most interesting, it's the most dynamic.
We look at it from a demand side of the table.
Yeah.
But if you go and ask the carriers in the market, they don't know what the broad market demand is.
Right.
And they judge their conditions of the market entirely based on the balance of supply and demand. And this index that you've got pulled up, the tender rejection index, is actually how they understand the market and how they correlate it. So you can have strong, as we saw in the first half of the year, you can have stronger volumes and it feel like a really bad down year if you have too much capacity. And the tender rejection data is a percent of loads that are rejected, which means out of 100, what percent of my freight is being turned down or rejected if you're a shipper. And we're looking at, and my eyes can't see this far, but I think it's 3.4% is what it's showing right now, which means out of 100,
it's all
only
the way
3.4%. If you remember pre-COVID, the low on this data was like 4.5.
Yeah, it was, I think this is the story that the carriers feel and why everybody is seeing suppressed rates is because the OTVI shows a kind of a positive outlook, a bullish outlook.
And that is closer to what the economic data would suggest.
Yeah.
It is closer to, if you took the OTVI index, and I get asked this a lot going Twitter, is when we talk about softness and carrier bankruptcies and trucking conditions, people often ask me, are you projecting a slowdown in the broader economy? And I, frankly, am not an economist.
Right.
I only look at what the good side of the economy looks like. So much of the economic GDP data takes in services. Only 40% of the GDP is actually answered in freight. And let's not forget that a lot of what's driving the GDP expansion is government spending.
Yeah.
And remember what we're talking about. We're talking about roads and highways. So that's things like asphalt. Asphalt doesn't get trucked over long distances. I mean, there's an asphalt plant in practically every city in the country. Gravel doesn't get trucked over there. And they're building bridges, they're bringing in steel, a lot of that goes on railroad, but again, it's big dollars, but not big volume. Right. And so a lot of what's driving the GDP expansion is construction jobs and stuff in these big infrastructure projects. Government spending as a percent of GDP is at an all-time high, and when you look at, or all-time non-war high, when you look at the percent of what it means for the economy, it means that it's putting out a lot of output that the freight economy is not seeing.
Yeah, I totally agree with that. The government spending aspect of this, I feel like is a little, anybody that lives in Chattanooga knows they're working on the roads.
They've always been. I think every city in America, except for some places in Texas,
it does feel like more.
They certainly do, but a lot of it's related to the growth of the economy.
But to your point,
locally.
To your point, this is almost like a very, and it's not just freight, but there's other sectors of the economy that are totally like 4.9%. That doesn't make any sense, especially in the retail sector, even though there was
consumer goods are stretched. Consumer credit has been stretched. Consumers max out their credit cards or have maxed out their credit lines. Auto defaults, in terms of auto loans, have defaulted. If you take out a loan, and I have good credit. We were getting, at sort of the lows of the market, we were getting 0.8% rates on cars that when I bought a car during COVID. And my wife, we have 5 kids, so it takes a big vehicle. My wife wanted another a Yukon to haul our tribe around. And, we're talking to the dealer, and the first quote we got was 12.5%. And we finally got them down to 9.5%. That was the lowest rate that we could get on that vehicle. That's kind of insane when you think about the fact that we actually didn't end up buying the vehicle because, it would have meant trading in the car that was at like 0.8% for the 9.5%, and that math just didn't work. And, I have good credit. My family has good credit. You take someone who is perhaps doesn't have good credit or is marginally bankable. They can't afford a car. They can't afford a house. I mean, look at housing payments. And all this stuff is starting to really show up. I mean, one of the interesting stories over the weekend that we caught was, so I went and did a big tweet about all of the bankruptcies we've seen in the space. And really just how dire some of the conditions are in the market, the freight brokers and the carriers. And somebody pointed out that I had missed probably the biggest story, which was this small community bank in Iowa. We've had 5 bank failures this year. The small community bank in Iowa, actually, the FDIC seized it. And the reason the FDIC closed the bank down is it was insolvent. And the thing that made it insolvent was its trucking portfolio. It was lending, it was the commercial lending aspect of it, i.e. truck financing, where it had lended money out to trucking companies, not just one. People have asked, hey, is this a Yellow story? My understanding from looking at the documents and talking to people closer to the situation is this was a portfolio. They were doing loans to owner-operators and broader trucking companies, and they got bit in that they have to mark to market the cost of the equipment and look at defaults when stuff defaults. And what they were seeing was that they were underwater. And that forced the FDIC to close the bank. And so this is another casualty of the bloodbath, as we called it.
So I think my next question here, because we've been talking about the interest rates and obviously the debt increasing over the last year, it seems like that is a forward-looking threat, economically speaking.
It absolutely, because liquidity drives the economy.
Right.
I mean, what is mostly, take a common person on the street that doesn't spend a lot of time looking at GDP data or doing it, and you ask about the economy, and they instantly resort to jobs, which is really how the Federal Reserve and the government sort of talks about, because it's very personal to us.
Right.
What actually drives economic activity is the amount of money that's in the system, liquidity. And when you start having banks fail, or banks that their ability to lend credit starts to seize up because they're underwater for whatever reason, then that is actually what slows the economy down. And now we have a situation where a bank, it was a small bank, it was like a 40 billion or 50 billion, 40 million or 50 million, big difference. Yeah. In terms of assets under management. And they had a $21 million trucking commercial portfolio. It was like 40% of the overall bank's credit had so much exposure to trucking. And in a good market, it wouldn't be bad. But there are other banks that have that exposure, and there are other industries that are facing it. And so these are some scary situations when the banks start to freeze up and liquidity starts to freeze up. That's when you start to have real economic stress. When businesses can no longer borrow money to go build a new manufacturing plant or hire new employees is when you start to see broader economic challenges.
Yeah, and so as that kind of, we move down the stream here, we've kind of focused on the economic output portion of this. We've identified the fact that demand is not a great read on the freight market and some other sectors of the economy. But pulling this back into the freight market here, so if we're talking about a debt situation and a liquidity situation in the United States, I've got the NTI here pulled up, and this is the spot rates, the average spot rate for dry van loads moving in the United States over 250 miles in white. And then I have that paired with the OTRI. So the rate situation, compared to 2019, nominally, it's not as bad, except for the fact that there's a bunch of fuel.
Well, let's just point out that the red mark is the tender rejection data, and the white mark is the spot data, net of fuel.
So it actually includes fuel. Otherwise, it'd be flat to 2019. So my question here is, seeing as the trucking sector has already kind of, or the transportation sector has already kind of had the wind pulled out of its sails, what does this forward look feel like to you when you see that rates have basically come all the way back down? We've got tender rejection rates all the way down. that has to mean
There's not much further for them to fall.
right.
Like, if you look at it, so tender rejection rates, I mean, you can't go below 0.
Yeah.
By definition, it is literally 0 to 100%, so it's not going to go negative. You can't have negative tender rejection data. Spot rates conceptually wouldn't go below 0. We did see during COVID that oil went 0, where they were paying you to move it. It was a weird functionality of the financial markets and system. Rates are not going to 0 either, because drivers are just not going to haul it. But we're at a point where now, I've seen banks have published this, I think JP Morgan had said it, that every mile that a driver drives, or on average, every mile driven is a loss for a trucking company. And you go back and look at 2019, you look like you're higher. This, of course, you pointed out, includes fuel. So fuel is answering some of that, but let's just look at the cost increases for all those carriers. You had driver wages that went up as carriers fought for drivers. You had insurance costs that went up. You had maintenance expenses that went up. You had operational expenses that went up. You had this massive increase, at least 30 cents a mile.
Right.
Increases, not including fuel, that now your break-even is much different. So I don't think spot rates are going to get any cheaper. Like, if we see marginal deterioration, maybe it goes down to the low, maybe another 4 to 5 cents in terms of like really falling apart in Q1 of next year. It's not going to get much lower than that, because carriers are simply underwater.
Yeah.
And when they're underwater, and they have a choice, they can either leave the industry entirely, or they can continue to run just for enough cash flow. Because remember, a lot of these expenses, they may be underwater in terms of what it costs to operate a business long term, but they're able to generate enough incremental cash flow that they can pay a portion of their truck payment, or maybe all of it. Maybe they're not making enough income to pay for their own salaries of their own operator versus what they alternatively could, but they're sort of stuck in this truck payment. Right. Insurance comes once a year, unless it's escrowed. Your truck payment comes once a month. Some of these costs, the plates come once a year. They don't hit immediately. So a lot of the carriers can operate in sort of this cash negative basis for a while, or loss basis for a while, and hope that the market will return. And what's going to take is this cycle, because it's so long, we're 18 months into it, it continues to beat them down to the point where at some point they're going to surrender. Now, they've held on. Generally, carriers have held on a lot longer than any of us expected. When I wrote my first article last year, it wasn't the recession article, it was the Bloodbath 2.0 article in mid-March. And it was interesting because my assumption was based on my own historical reference, which is when you have a pretty rapid deterioration in conditions, you see a massive purge of capacity. Now, two theses we had. The question is, why have we seen so many carriers stay in the market longer? And why is this market? Because everyone, myself included, I think you also were in this camp, believed that we would see a lot of capacity churn out of the market a lot faster. And they've held into the market a lot longer. And the question is, why? I think there's two foundational reasons for this. One is they were able to shore up their balance sheets during COVID better than any of us expected. For sure. But that eventually goes away. Yeah. The second reason, I think, is the shift in the freight market. So if you look at every other recession that we've had, the 2015 recession and the 2019 recession, the most recent, the one everybody likes to compare this is the great financial crisis in 2008. But if you look at the percent of freight that represents the brokerage industry, it's so much bigger of a percent of the trucking business than it has been in the past. And there's a reason that this is really important, is that brokers, when the freight market falls apart, typically, two things happen. Rates drop precipitously, but also your freight opportunities drop precipitously. Is now carriers that were normally in the routing guide are taking all of those first opportunities, and typically asset-based carriers have been higher in the routing guides than brokers. But over the last 10 years, we've seen this shift where freight brokers have played a primary role in a routing guide. As it used to be when I was in freight back in the day, brokers were an alternative, and they didn't get primary positions in routing guides. We have seen the proliferation of brokers where they play a primary role, and so now what's happening is those brokers are providing continuous lines of demand that enabled the carriers to get additional cash flow and load opportunities that they wouldn't otherwise be. And that's why I think they're holding on a lot longer than they otherwise would be.
Yeah, so your theory here is that the brokerages are basically linking the larger shippers to some of these smaller owner-operators that don't have a way into these route guides.
Absolutely. And look, you can credit, we've talked about Convoy today, but it's Uber Freight, it's the Arrive Logistics, it's all of this proliferation of freight brokers. If you go back to 2000, most people have forgotten about this. We've talked to this a number of times, is like freight brokerage was effectively illegal with some exceptions until 1985. Like it was a part of the whole deregulation of the interstate commerce. Like the whole trucking deregulation brought about the proliferation of freight brokers. And when I was dispatching freight, when you and I you got in this industry back in 2002 or 3.
3 or 4.
Freight brokerage was still a cottage industry. It was like single digits, 6-7% of the industry.
Oh, it was discount freight. It was backhaul freight.
Nobody wanted it.
No.
I mean, we had a rule, and some of the larger carriers still have it. You didn't take broker freight.
Right.
Unless it was absolutely, you got a truck in Montana. You had no choice.
Yeah, they were kind of a function of what some of the modern asset-based brokerages do today, and that's find, in a function.
In an intermittent load.
They find the backhaul load to get their network back in balance.
But over the last 15 years, that's changed. In fact, if you look at the data, unfortunately, I don't have updated data, but Armstrong and Associates did this study where if you go back to the financial crisis, we were at 10% of the freight was booked through brokerages. 2018, which was where the data left off, they were at 18%. And we have not measured it in terms of scientifically, but at least a quarter of the freight during COVID, maybe a third of freight was handled through brokers during the COVID extremes. And so you've had this proliferation of freight brokers that have taken such a significant portion of the market that have enabled small independent trucking companies to basically get access to high quality freight. Because as an owner operator in the old days, I would get stuck with the loads of hay, the loads of paper and packaging, like stuff that was not high quality freight, the stuff that was driver unload.
Right.
And what's happened is the freight brokers have sort of filled up this really necessary void of enabling, they play the role of a sales agent for a carrier, they play the role of dispatch, they play the role of track and trace. For them, they provide a lot of the functions that a larger carrier will. And that's frankly why almost every public trucking company has left the over-the-road irregular route business.
Right.
Knight Swift, the largest, is largely a DC to store business model, super regional and dedicated. Covenant, a company based in Chattanooga, has largely left the over-the-road trucking business because you can't make money.
Right.
It's hard in long haul to make money in the over-the-road trucking business. And so what's largely happened is that the brokers have taken on significant share of that business, and that's really been the lifeblood for owner-operators, and that's why they've survived as long as they have in this cycle, and will continue to create enormous amount of pressure on the market.
Do you think this chart that I have pulled up here, this is our contract rate, average contract rates in white, and then this is compared over the top of our NTI, excluding a comparable amount of fuel to a standard fuel surcharge that starts at about $1.20 per gallon. So these are two, apples to apples comparison in terms of overall rates. The spot market obviously moves faster than the contract market. But I think, something we've hit on as, we're expecting the market to really fully, deteriorate. We see capacity exit more. It's surprising to me that the contract rates are still so high compared to spot rates.
They're high relative to spot.
Yeah.
And frankly, it looks higher than it was in 2019. Now,
right.
A lot of that is addressed in the increases of cost. So I don't know if you were here when Ben Ball from Shaw and I were talking about indexing contracts, and Ben I asked him about upcoming RFP season. And he asked him what he was expecting in terms of RFPs, and he said he's thinking about mid-single digit decreases in contract rates. So let's think about this for a second. In the contract business, the way it works is typically bid cycles. Yes, are there intermittent mini bids, and yes, does some freight end up in spot market, and yes, the shippers take intermittent decreases. But fundamentally, most large shippers are doing annual bid cycles, they're budgeting, they go to corporate and say, this is my budget, and they get it, and they put it out there once a year. And the larger asset carriers get the predominance of high volume freight, and they bid on this freight, and they end up putting bids. They're not gonna take a you won't see a Knight-Swift reduce rates by 30% or 30 cents a mile. They may take a 6% or even a 3% decrease in rate. The asset carriers are reluctant to give back what they believe that they rightfully earned during COVID and have had to eat additional cost increases. They're reluctant to give that up.
Right.
And one of the things that a friend of mine that runs a $1 billion plus freight broker pointed out to me that you and I had talked about, why is this phenomenon, why contract rate stable, that I had missed was that a lot of the RFPs mandate through corporate that at least 75 to 80% of the freight awarded has to be awarded to an asset-based carrier, not to a broker. And that is why that contract rate is not under pressure, is they took the big swing, the reductions in Q1, they implemented cheaper rates in Q1, and now we're in between bids.
Between cycles.
And we will probably see if Ben is correct, and $150 million freight spend would suggest you know something about this. We will see another 6% or greater decrease in that contract rate. The spot rate, arguably, and that's that purple, is that purple or magenta or mauve?
Light mauve, yeah. I think
It's pretty.
You got that right.
But when you look at that line right there, it's not going to get much lower. That contract rate is, and this is where it gets really, call it detrimental to brokers. If you're a journalist, sort of interesting, but not in a good way. This is where it can be really painful for freight brokers because they've lost volume, because they've largely lost a lot of the sort of excesses that exist in their business. And so they sort of lost the volume equation. They haven't lost the margin equation because they're able, in those contract rates, they're able to live here and they're able to buy here on spot. Right. That spread is important to them. Freight brokers, and you can go back, look at public traded freight brokers and look at historical data. Freight brokers get squeezed when that spot rate comes up and that contract rate stays either flat or goes down. And if we believe that the contract rate is going to go down a couple of % next year and the spot rates are going to increase, we will see margin compression. That is when a lot of the freight brokers will feel real substantial pain because those RIPs, is the industry term for spreads, those RIPs will no longer be available to them. They won't get the strong spreads that they have been getting, and that's when we will see substantial squeeze on their business. One of the things that a number of people have pointed out to me, and this has been pointed out for months, and I wrote about this, is the concept of how these high-growth freight brokers funded their business. And during the sort of 2010 to 2022 expansion, and particularly in the latter half of the decade, a lot of them use some form of financing, whether it's equity financing or asset-based lines of credit. And those ABO lines funded a lot of the hyper-growth, is they could effectively grow their business in advance of their cash flow.
Right.
And there were margin covenants put on by these lenders that said your margins had to stay within a certain range. And if you violate those covenants, the lenders had the right to seize your, basically call the note in. And if you couldn't clear it, you were out of business. And we have seen 4 bankruptcies of brokers this year. Convoy obviously is the biggest, but we had Surge. There's a number of other brokers that are out there. I'm going to be reluctant to say much more, but there are more coming. I talked to a lot of folks that we do a lot of channel checks, and there are more. There's certainly more. And be careful not going further because I end up getting myself in trouble when I make these statements. But there are more coming, and there are some names that are more common. And I think when that happens, it's going to be challenging.
Yeah. So I mean, to that point, now you've written an article as well that states that things are probably going to get worse before they get better, effectively stating that we're about halfway through the cycle, mid-October-ish, somewhere in there. Yeah. And this chart right here is sort of an explanatory. You're looking at total carrier trucking authorities based on some FMCSA data. Carrier Details is kind enough to do a little bit more legwork on this and clean it up to where we actually have removed some level of lag on this data, but that is total trucking authorities, and we obviously see it.
You're talking about the white line?
The white line is the total trucking authorities. Huge expansion during the COVID era. Obviously in response to the OTVI there, exponential growth in demand during COVID, and it's slowly coming down. And so you use this data to basically estimate. We had another, we were about halfway through it mid-October, and we had another.
78 weeks is what I came up with. If you look from where the March 31st, when I wrote that article about the freight recession, when it sort of effectively started, if you will, to when I wrote the article, it was 78 weeks. And when I looked at the data, it suggested we were right at halfway through. It was coincidentally, it happened to be conveniently halfway through. What's interesting about this is just take the blue. We can't remove it right now, but let's just take and imagine that that white line is a hill. And you're running up this aggressive hill. You know, that would be a pretty tiresome hill if you ran up that. And on the way back, it's very gradual.
Yeah.
And I think what's really interesting about the data is it says that we had this massive expansion. And if you imagine this being a hill that you're now coming on the other side of it and sort of peaked on that white line, that's a much slower, gradual pace. So all that capacity build that we had during that period of time is still with us.
Right.
And that is what's keeping the market really, really painful, regardless of what the GDP or volume data suggests it should do otherwise. And that's why I think there's an enormous amount of pain, and we've not seen the worst of it. You know, I had said something a couple of months ago that I think it may have been April, May of sometime. We actually had this conversation a few times, is that we hadn't seen the purge. Rachel Premack had predicted there would be this massive purge, a reset of all the capacity in the market, and we hadn't seen that.
Right.
And one of the things that was always like, why? But as I was doing this weekend, I was going through all of the old stories that we'd written about the bankruptcies, and I was like at 27. And we've gotten to the point where we're not writing about single operator bankruptcies. Right. I think the editorial team won't take anything less than, I think it's 50 trucks now, maybe 25 at one point. I think we've now moved it up to 50. We're at 26 bankruptcies, and some of them have been big. And we've talked about Yellow, we talked about Convoy, but there's been a lot more of this purge happening. And it's just gonna continue to compound.
So this is the net change in trucking authority. So it includes the additions as well as the exits, the net revocations. And basically you can see, obviously the big green, that's the growth phase of the market, again, in COVID. And then the red is the more negative, the net exit.
But it's not Christmas.
It's not Christmas.
But
it's anything but Christmas.
The green was Christmas.
The green was Christmas.
That was when there was massive expansion.
For every year for the next 10 years, especially in the consumption arena. But so my thought here, so we see that we've been in a contractionary phase of capacity. We're still net like 100,000 operating authorities.
I think I had estimated it was on 68,000.
Yeah, well, I'm saying since about, when I did a calculation, it was from the middle of 2020 till about October, it was like net 100,000 something. Anyway, my question to you here is, we were, like you kind of said, when the market fell, we really had this buffer built in. This rate of change has kind of stabilized over the last 12 months.
I mean, look,
do you see an acceleration?
I'm sorry?
Do you see an acceleration after this?
Well, there has to be, or we're going to be in this mess for a long time. I mean, just take that chart, look at the green, which is the expansion cycle, and just look at how high some of those data points are.
Right.
And look at the red and look at how narrow it is compared to the green. You can look at the chart and see that right there. And look at how much longer the green section went on versus this cycle of the red, the right part of the chart. You can see, you don't have to be a data scientist to do the analysis to say there is more capacity in the system than there was. That expansion cycle has gone on longer than the contraction cycle.
And it was a lot stronger.
And is a lot stronger in expansion. So it takes a while for this market to reset. And that's why there's just a significant capacity overhang that continues to live with us. And one of the sort of realities is this economic GDP expansion is actually making it somewhat worse because it just means that, look, if you really wanted to just press reset, and nobody wants this because this means significant economic pain, but if you actually just want to get rid of a lot of capacity, then you would hope for some massive downturn in volume overall because that would clear out the system faster. The problem is you will take on a lot of companies and a lot of innocent people get really hurt from that. So I don't think anybody wants that. It just means that we're going to live in the soup for a long time, and frankly, the strong will survive.
Yeah,
if you came into the cycle with a weak balance sheet or a deteriorating balance sheet and you didn't have good, high-quality freight, then you're going to be struggling for longer.
So I accidentally hit the button too many times. But So moving into, this is another nuance of the market that we're dealing with, is this fragmentation. Obviously, economically, we're fragmented, but even if you break down some of the trucking data, we're a little bit nuanced and disconnected between sectors. This is the flatbed outbound tender rejection index with the refrigerated outbound tender rejection index in blue, flatbeds in orange, and then the van is in white. Now, van, of course, represents the gross majority of freight and capacity in the market. Refrigerated, probably number 2 in there, flatbed, a little bit smaller. But my question to you here is, are we seeing, you see that refrigerated basically, and if I had pulled this all the way out, van and refrigerated during COVID were where flatbed is at the beginning of this chart. Like way up. We had 40 to 50% rejection rates for refrigerated. Van was in the 20s. Flatbed was kind of below these two for a long period of time.
It certainly was trading at the bottom.
Yeah, and now flatbed after we
But
came out
remember
of
what
COVID,
drives flatbeds, Zach? That's housing.
housing, construction, energy.
I mean, a lot of it is energy for certain.
Automotive.
And automotive, but a lot of that is housing. Housing is the most important part of the flatbed market. Not to say that are there products that aren't, but like what you're seeing is this recovery of the housing market and new single home expansions. And you're seeing the interest rates and mortgage rates continue to churn out and cause problems in the housing market. And housing prices have not really fallen on a national basis, but nobody's buying houses right now. I mean, some people are, but not very many. And so builders are not willing to take the risk. I mean, if you look at the cost of capital for a builder, you're talking 7, 8, 9, depending on the credit, 10% for a builder. And they don't know what the economy is going to look like in 6 months, 12 months. It's a big risk for the builders.
So, I mean, the flatbed looks like it's still relatively
It's better,
stable.
right? It's better. Refrigerated's coming back.
But I think that right there is my question to you. Since flatbed kind of was on an island during COVID, we had this unique kind of bubble. Van and refrigerated fell. We've never seen refrigerated be so close to van in the past. And yet, well, here we are now. Do you see this refrigerated sector being less served and basically kind of an early signal?
I think the reason the refrigerator market is getting better is one, it was a tighter supply of refrigerated trailers during the COVID cycle. It's harder to add a refrigerated trailer. It's frankly harder to add a flatbed trailer. Yeah. Flatbed trailers live on a little bit longer than refrigerators because they have refrigerated units. The second element that's probably less discussed is, remember, that refrigerated takes fuel.
Right.
Diesel prices have shot up. It takes fuel to funnel those things. The cost of operating a refrigerated trailer is higher. There's just tighter capacity there. And so what you're seeing is a more rationalization of that market. I think fuel prices do impact how carriers do it. If you don't get a break-even price, you're probably apt to take that. So I think that's part of what's keeping that refrigerated price, or at least refrigerated rejections a little higher than what you're getting in there. Is that people are saying, look, I'm not going to run my refrigerated trailer at a loss.
Do you think that the capacity has left that space a little bit faster?
I think it's faster. Those markets will correct much faster.
Yeah.
I mean, flatbed needs the housing market to do well before it truly corrects. Refrigerated market certainly is correcting faster. Van is unfortunately going to stay. Van is 75% of the market. Right. It's going to stay in the lower portion of that rejection rate until we see a capacity churn out, and it will be one of the things we've sort of been caught this year is like we have seen these sort of early increases like in January and for sort of like, oh, we're out of this, and we saw in the summer one, we're out of this. I think one of the temptations is to call it too early, and we've done some of that. We called some of the recovery too early and think that, hey, things are better. And I think what we're seeing is just the market as it increases, all of a sudden you start to see incremental capacity come into the market that wasn't there, and it sort of beats that down. And so that's something. I mean, one of the things that I've heard, and I've heard this from multiple sources, is some of the larger asset carriers that are well-financed, and this sort of breaks the rule of everything I know about trucking, is they're actually parking some of their vehicles against the fence because they're going to rationalize how much freight they have, and they're not adding drivers where they don't have demand. And so they're parking some of those vehicles against the fence. And so they have some incremental capacity that they can bring into the market when it recovers, but they don't want to put miles on the truck, and they don't want to dilute the opportunities that exist for their drivers versus chasing drivers to put them into a market where there isn't enough freight. They're reducing some of the capacity. And even the airline, the FedEx and UPS are doing this, where they're actually paying pilots or encouraging them to go to the airlines, $250,000 as a captain to leave FedEx and the cargo airlines are doing the same leave.
Right.
You know,
We'll pay you to leave.
a year ago or 2 years ago, they were scrambling for pilots, and now they're actually paying them to get out.
Right.
And it's just an interesting time where everybody's trying to rationalize capacity, and that's what's causing some of the maybe causing some of that incremental increases that you're talking about. But it also means that as we see increases, it may not be a V-shaped recovery.
Sure.
It may be a slow churn.
A little bit of a choppy thing. So I want to make sure that we have enough time if people want to ask questions.
We have
mics.
2 mics, one there, and I can't see the other one.
I can't see the mics.
Right there, right there.
Scream at us.
If you'd like to come up and ask
Yeah.
questions, just stand up to the mic, and we have those.
Yeah.
I think we have, Bo came.
Bo, here we go.
We
All right, Bo.
expect Bo to ask questions.
Absolutely. Come on down.
Thank you. One thing you haven't shown so far is the inbound TEU data, right? And that's something that's also encouraging you may want to see is over November here, specifically, it's starting to build back up again.
There you go, Bo.
Yeah, so what do you guys see in this data? What does it tell you in the next couple of months? Because obviously nobody's fulfilling for Q4 left at this point, right? This is all for Q1. So what is this starting to tell you?
I think, I've listened to Henry Byers, our maritime market expert, talk about this, and he admits this has been a surprisingly resilient situation in the maritime sector. And the consumer has been spending more than they have, honestly. And this has been, we've talked about the inventory levels being an issue early in the year. That seems to have largely corrected. But if you looked at the LMI data, which I have also on here, I believe next, this of course shows the inventory levels have been contracting in large part. Anything below 50 is contraction, anything above 50 is expansion in inventory levels. So this tells me that inventories aren't being aggressively replenished either. And I think with the surprising resilience of the consumer, that's what's really fueling what you're seeing on the maritime side right now is a lot of that. And I think Henry kind of says that this is, good news in general, but, in terms of overall stability, we're still not out of the woods yet.
Well, it was an early peak season, and I think it's exactly what you said, which is it was an inventory rebuild where a lot of the retailers 75% of container market is retail consumer goods.
Right.
And what was happening is the retailers had, if you think about just the 12-month cycle, they saw the collapse in in a massive increase in inventory build. They pulled back aggressively because they're doing 12-month planning cycles on inventory. And they didn't add significant inventory last year. And and 2 things happened. One is they started to burn off that inventory.
Right.
And China experiencing a significant deterioration in its economy and manufacturing base started to really get aggressive. Some of the manufacturers over there started to get really aggressive on cutting concessions to encourage retailers to take inventory. And I think they have been opportunistic to do so. We're back at a more rational ocean market. Now, the ocean carriers are certainly not feeling what they call rationality.
They bought too many boats.
Well, they ordered too many of them,
Yeah.
and a lot of those have not actually come online yet. They will over the next 12 to 18 to 24 months, and so that will continue to decrease, put pressure on the ocean container lines.
Yeah. And
Great question, Bo.
Yeah, good job, Bo.
Anyone else? We have 2 mics here.
Yeah. Just come on up and talk over us, especially since I can't see you. One of the things that I think is interesting, this nearshoring component of, this is obviously going to be an underwriting theme as geopolitically we are in a very tumultuous space, to say the least. And I think diversification and nearshoring and all the things that are kind of de-risking supply chains right now are a component of long-term strategies. Do you see any of this kind of manifesting? How do you see this manifesting, I guess, in our domestic market?
I mean, we've seen in the data, I don't know if you've got the data points on volume as market share. So we have one index. We have one index that tracks the market share of markets relative to the whole market. So it's hard to look at volume of the freight market and look at from just a pure raw volume standpoint, because it doesn't tell you a lot about how it's doing relative to the overall market. I mean, a lot of freight moves regardless of origin, it's going to move in sort of a similar cycle to the broader economy. And one of the things that we have built is this thing called market share, which looks at outbound tender market share as a percent of the overall freight economy. And one of the most robust markets in the country, and there have been 3 very robust markets. One is Detroit, which is auto. The second is Houston, which is a combination of energy and sort of the Americas renaissance. Places like Colombia and other parts of Latin America, Mexico have increased. But Houston's, a lot of that's related to chemicals, energy related, and commodities. And then Laredo, Texas. What's interesting is that El Paso, I did this study for an investment firm that was looking at buying physical warehouses and manufacturing real estate along the border. And we did this study of Nogales, Tijuana, El Paso, and Juarez, and even Brownsville and Laredo. And Laredo was the one market that saw a massive increase in market share. And it was up something like 250% where it was pre-COVID. It has now become, once again, and it was before, the largest freight market port in the United States. Not largest freight market, but largest port of entry in the United States. And it just shows you that that's a pretty resilient part of it. And I've talked to some real estate firms, industrial real estate firms that are saying Mexico is on fire right now, is that there is just so much demand for Mexico real estate in the industrial sector because everyone realizes that this shift from Asia to the United States is real. And it is certainly geopolitical in nature, but also one thing that's less talked about is the cost of, on a per hour basis, the cost to produce in Mexico versus China. Sorry, I didn't mean to sound like Donald Trump when I said that.
China.
I did not mean to sound like Donald Trump. But it's so much more expensive to produce in China than it is in Mexico on a per hour basis. And that's largely a phenomenon of just Chinese manufacturing has become more expensive because they don't have the ready amount of labor that they once did. There's a demographic challenge in China. And so a lot of that opportunity is that manufacturers are saying, hey, Mexico sounds like a pretty good spot to put some of my manufacturing and production.
Right. Yeah, I think we've also seen some shifts domestically in the Phoenix market as well. Not necessarily a huge border crossing, but we've also heard tales of McAllen. And they're building infrastructure out down there to cross the border. And I think that's fascinating.
I think McAllen and Juarez, El Paso, those are sort of secondary markets. McAllen has done well typically, but Laredo is still the most important market.
It's already got the infrastructure.
I suspect that we'll see some of these secondary markets as we sort of see expansion take place. I mean, you are starting to see more investment in the Mexican economy move south. Like a lot of the sort of benefit of the NAFTA trade, if you will, when NAFTA was still what it was called, was largely along the border. And some of the, within 100 miles of the U.S.-Mexico border. We're now seeing more intra-Mexico trade and industrialization happen. And the central government of Mexico is starting to focus further south, sort of following the Chinese playbook.
Yeah. Got a question?
Thanks, guys. How do you see 3PLs sort of navigating the changing thing? Do you think shippers are going to be going more toward them? Do you think that they're going to be sort of prospering in this uncertainty? Just curious for your thoughts on that.
I think the genie's out of the bottle for 3PLs, and what I mean by that is a perpetually growing market and expanding market. It is not going to go back to where asset carriers have lost the ability to control the market. And I think what I mean by that is it's nearly impossible for a long-haul asset carrier to make money at scale. There are few economies of scale. And 3PLs have been the ones that invested in technology. I mean, if you go look at this is sort of interesting. And I grew up in a trucking family, as many of you know. And if you go look at trucking companies, as a general rule, they don't invest a lot in, most of their investments in technology and in marketing is the equipment on the trucks, and it's the driver recruiting. Very few asset-based trucking companies advertise their services to shippers because they get the RFPs in anyways. Most of the advertising we get at FreightWaves in terms of marketing transportation services comes from the 3PLs. The 3PLs are far better positioned in terms of understanding solutions-based selling. They're far better at marketing their products to a client base, and they invest more in technology, improving their operations around execution than any of the asset-based carriers do. And I just think that because of that, the 3PLs are far more agile. They don't have the overhang of equipment. There are going to be some brokerage failures, but generally, if I had to place my bets on who wins, I'm always going to invest in the 3PLs. And I also say this is like, the asset carriers over the last 15 years have figured this out too.
Right.
A lot of their investments have gone in building these brokerage operations. And if you look at, with the exception of what Knight-Swift did with US Express, most of its investments have been to diversification outside of the over-the-road trucking business into things like LTL and other services. Covenant has largely exited the truckload for hire business and moved into warehouses and managed trans, and I think those trends will continue.
Yeah, absolutely.
It's a great question.
Yeah.
And it's often, I grew up and I was told that there would be massive consolidation in truckload. And look, the largest truckload carriers, over 1,000 trucks, I think was the number. It was over 100 trucks, represented 52% of the industry back in the great financial crisis, and represent 42% of the industry today.
Yeah.
So we've seen fragmentation, and that's just going to continue.
Yeah, I do think though that like you said, the genie's out of the bottle on 3PLs. They definitely have the flexibility to navigate the market a little bit quicker. Their willingness to invest in technology, I think, is really what differentiates them. And I think the fact that means that they can get there faster in terms of their service, not necessarily in terms of moving the truck, but getting there faster for customer service.
They shouldn't be filing bankruptcy.
Yeah.
I mean, I can't remember prior to this year, we saw non-asset-based trucking companies file bankruptcy. Mm-hmm. I can't remember, we do bankruptcy stories all the time.
Right.
And I can't recall a bankruptcy that happened to a non-asset-based only freight company until this year. And what's happened is we moved from a zero-rate environment to cost of capital and ABL lines, and these brokers were not aggressive in taking cost reductions. Convoy story is a little bit different because it was venture funded and it didn't have a sustainable business model. But those companies shut down. But asset-based carriers are quite different. We did a story this weekend of Elite out of, I think it's Pittsburgh, had reduced like 70 of its employees or 85% of its staff. If that was an asset-based trucking company, there would be zero question about bankruptcy.
Right.
A broker could effectively reduce 70% of its staff and potentially still survive if somehow it could just survive a liquidity crunch.
Yeah. I think we'd be remiss if we didn't at least talk about Yellow's exit and the LTL sector quickly, as we only have a few minutes left. But I have the LTL average rate per hundredweight, for those of you that are familiar, in the white line, and then the average van truckload rate there in the green line. Now, Craig, typically we see the LTL market follow the truckload market, but that didn't happen this year. Do you think the Yellow situation is something that is, one, propping the rates, and do you think that there is some dust that has to settle here?
It's an interesting question. I actually get asked this a lot.
Yeah.
Mostly from Wall Street investors who actually feel like the LTL business is a more investable,
right,
which arguably it is. I think I agree with them. It's a more investable class than if you're in trucking, particularly asset-based. And yes, I think what the LTL firms have benefited from is two fundamentals, or three fundamental challenges or opportunities. One is Yellow has reduced a lot of capacity. 10% or 9% of the capacity is reduced from the market. That helps. There are significant barriers to entry and moats around the business. The other thing that it benefits from is when shipment sizes shrink or are smaller, LTL is oftentimes last and first out of a downturn, right, because the shipment sizes are smaller. So it has certainly benefited from that. Truckload is a story of too much capacity.
Sure.
Like if we just boil it down and you had to come up with a simple answer, we can talk about the economy all day long, but until you actually talk about capacity, you've not really talked about the issues in the truckload business.
Yeah, and the LTL market is infinitely more complicated in terms of, you don't just have a truck and all of a sudden you're an LTL carrier.
No, you got to have warehouses. You got to have infrastructure. You got to have
works.
pricing departments that understand 100-weight tons. It's not
Discounts
getting
off-
onto a rate system and doing
Discounts
it.
off our light, 99. Anyway, well, thank you, Craig. We're right at time, so
Thank you so much.
Yeah.
And you can see us every single month. It's free.
yeah.
We put it out a couple of days, usually a couple of weeks before. So it is the State of the Freight webinar. It is free. It takes about an hour as we go through it. And I really want to thank everybody for coming. Thank you.
Enjoy your lunch.